And welcome to Armanino's webinar this afternoon, ASU 2016-14. We'll begin in just a minute, but before we do, we'd like to just go over a few housekeeping items. My name is Michelle Maranaka, and I'll be your moderator for this webinar. So for our software this afternoon, we are using GoToWebinar, so please feel free to use the arrow to minimize or maximize your pane. You can also type in questions for our panel this afternoon. Feel free to type those in, and we will address those questions at the end of the webinar as time permits. For your audio settings, we want to make sure that you can hear us. So the software should detect your automatic settings. If you would like to change that, however, you can. Go ahead and select a phone call if you're using your phone call to dial in, and select computer audio if you're listening in through your computer. Our session this afternoon does qualify for CE credit. So in order to qualify, you need to follow these 4 rules. So the first one is you need to use a personal computer, no smartphones, and log in with your own information and unique URL. You must be logged into our software for at least 50 consecutive minutes within the scheduled time frame of the webinar. You must actively respond to at least 75% of the polling questions, and we ask that you complete the evaluation survey at the end of the webinar. We have 3 presenters with us this afternoon. The first is Renee Ordonneau. She has over 25 years of experience in public accounting. She specializes in the nonprofit sector, and her accounting expertise extends beyond audit to income tax matters pertaining to unrelated business income and non-recurring business transactions. Our second presenter is Michael Cantrell. He has over 25 years of experience in public accounting and has a range of nonprofit experience that extends to public service, membership, religious and voluntary health and welfare organizations, private foundations, private charities, and affordable housing. And last but not least, we have Stacy Kowalczyk, who has more than 13 years of experience in audit and accounting. She focuses on serving nonprofit entities, including community-based social service organizations, religious organizations, and private colleges and universities. So welcome to all of our presenters this afternoon. Here's a look at our learning objectives. We will discuss the changes between the 1993 Statement of Financial Accounting Standards and the new ASU. We will examine how the changes will affect donors, grantors, creditors, and other users of nonprofits' financial statements. And we will identify implementation deadlines and the benefits and pitfalls of early adoption. This is a look at our presentation overview. So we will cover the following: net assets, disclosures for net assets without donor restrictions, endowment disclosures, functional expenses, cash flow, which includes direct versus indirect, presentation options, restrictions on long-lived assets, and liquidity. And with that, we're going to go ahead and get started with net assets, and I will turn it over to Renee.
Thank you very much, Michelle. This is the biggest pronouncement impacting nonprofit organizations since the 90s. There's a fair amount to cover here, and don't worry, there'll be other opportunities. It's a while before you're actually required to implement this, and we will go over the dates. But we're hoping that this will serve an introduction to some of the presentation issues that you'll encounter. And we wanted to start with the big one. Net assets, since that 1993 pronouncement, have been presented in 3 different categories: unrestricted, temporarily restricted, and permanently restricted. The new ASU simplifies those and takes us down to 2 different classes: those net assets with donor restrictions and those net assets without donor restrictions. And here's just a definition of what a donor-imposed restriction is. I don't think you'll find this being particularly different from what you're currently using. So basically, this will allow you to simplify the presentation of net assets, and it does require that it go back to the earliest period presented in your financial statements. So if you're doing comparative financial statements, you'll change it for both years, and it's even possible that there might be some changes in classification. We're recommending that you don't change your internal chart of accounts. I don't know about you and Mike, Stacy, but I know I have a lot of clients who have some fairly extensive different assets that they, or funds really, that they need to track. Some organizations, of course, still do this in Excel. Others do it as part of their general ledger. And so we don't believe that there's really any need to make a change with that.
Yeah, we agree with that because you're still going to need to, as Renee said, your organization is still going to need to retain your fiduciary responsibility, and so it's good to keep that separated internally. Renee is also going to talk about some financial statement presentation options where you might still see some similarities to the current reporting.
Sure. As part of this, underwater external donor restricted endowments are going back into net assets with donor restrictions. So for those of you who experienced this when the relatively new standard came out on endowments, anything that was underwater was actually hitting the unrestricted net assets. To better conform to what the law is and honestly kind of how it feels to people, it's back in the net assets with donor restrictions. So this is an area where you really could end up in a different class, in which case you would need to do a prior period adjustment, restatement really, when you adopt the standards. Investment changes on external donor restricted endowments are reported in net assets with donor restrictions, pretty much the same as what you're doing now. Internal board designated endowments, again, no real change. It's going to be in this category known as net assets without restrictions, which is basically the existing unrestricted category. The most important thing about this is that there's going to be a lot more disclosure that is required, and we'll go over that later. In particular, you're going to need to be able to talk about the impact of donor restrictions on your liquidity and what purposes the net assets can be used for. And this could impact actually discussions about your assets and your liabilities. We've been talking about, how do we think that organizations should implement this. There's several options, and we're going to show them to you. Our recommendation really is that keep the face of the financial statements simple. There's only 2 net asset classifications that are required. You can just do with donor restrictions and without donor restrictions. For a lot of organizations, you will benefit maybe from some disaggregation. It's not precluded. We'll show you some examples of that, but don't go crazy with it. A lot of organizations that I have as clients currently are showing several different classes on the face of their balance sheet. I mean, Mike, I think a lot of your clients in the social services sector.
Well, we see obviously there's quasi-endowments that show up in both in the unrestricted as well as endowments get broke out separately. We see sometimes where there's brick and mortar gets like a set aside. Sometimes we'll see where a board will set up a reserve, and so there's elements, there'll be different elements within the unrestricted portion, certainly of net assets. As an alternative, though, is that with the fact that we're doing these new liquidity disclosures that Stacy will be talking about later this hour, we may not need to have this broke out now on the statement of financial position. It may be covered in those liquidity disclosures, maybe even better. So.
Yeah, absolutely. I think Renee said it best. You have a couple of choices, still within these new standards that are coming out. So it's really going to take some talking internally amongst your organization and with the board and, trying to figure out what makes the most sense in terms of your external reporting and who your stakeholders and users are.
Yeah, I think getting board or at least audit finance committee involvement somewhat early on, your financial statements can end up looking different than what they have in the past, and I think it's important that the board of directors is comfortable with the presentation that you come up with. I would certainly consider the board to be one of the primary users. So involve them in figuring out what's the best way to present. Stacey, was there any recommendations you wanted to add specifically for the school sector or colleges and universities? I know you work with a lot of those types of organizations.
Yeah, I do work with a lot of private colleges and universities, and I see, I see them having a little bit more transparency just in terms of not cluttering up the face of the financial statements and looking more towards disclosing some of that information in more detail in the footnotes. So I think that's the recommendation in that space.
Yeah, so keep in mind additional disclosures will be needed in the footnotes. So if your organization feels like you really want a clean statement of financial position, there's opportunity to do it elsewhere, but it does need to be done. Like pretty much everything else in the standard, the implementation timeline, it's effective for fiscal years beginning after December 15th, 2017. So for most nonprofit organizations, that's either going to be the December 31st, 2018 calendar year or the fiscal year ending June 30th, 2019. You can adopt early if you'd like to, and some of the changes actually could be made under the current standards. If you select early adoption, you're going to have to early adopt every single aspect of the standard, and there's kind of a lot here. So if there's changes that you want to make that you feel are advantageous right up front, it might be good to figure out whether or not you can do it under the current standard. So for example, in this particular case, if you did want to show some subcategories of net assets, you wouldn't switch to the new terminology of with donor restrictions or without donor restrictions, but the existing standard does allow you to have subcategories of unrestricted and temporarily restricted net assets. So we're about to go through very quickly just a few examples of how you could present the different net asset classes. And these slides will be available, as Michelle indicated, so you'll get to see copies of these different types of presentations. The first one, I believe, this one is a classified balance sheet, and when we get to this section on liquidity, Stacey's going to walk us through. She can talk a little bit more about the advantages of using classified versus unclassified balance sheet. But this is very simple. If you look down towards the bottom here, the net assets section has two lines, without donor restrictions and with donor restrictions, and that is the minimum requirement. The next option shows a bit more detail. So if you look down at the bottom, it's taking up about a third of the page in this example, and the section without donor restrictions has some of the things that Mike referred to with the board designated endowment. In this case, there's a capital replacement reserve and then a whole big bunch of undesignated net assets. But these could be things that, are important to your organization. For example, a working capital reserve. The with donor restrictions category here has it broken out between purpose restricted net assets that are time restricted, and then earnings from an endowment that are subject to the appropriation and spending policy. That last one, held in perpetuity, is basically the current equivalent of permanently restricted net assets. And I think that a lot of organizations may want to break out things that are just not going to be available on a more or less permanent basis. If it's not material, of course, there's not a whole lot of reason to put that right up there on the statement of financial position. But particularly if it's large, it may be useful to readers of the financial statements to call that out, particularly if you think that the folks who receive your financial statements are spending significantly more time looking at the actual statements as opposed to those footnotes. So we may be, yes, sorry, this is the unclassified statement of financial position. So a lot of nonprofit clients do not break up their assets or liabilities between current assets and long-term. And this is just an example of that, again, with the minimal breakout of the net assets.
Okay, and we have our first polling question. So in just a second, you're going to see it on the screen. And just as a reminder, to qualify for CE, we do ask that you respond to a minimum of 75% of the polling questions. So the question is, do you like less or more disaggregation of the net assets on the statement of financial position? So let us know. Do you like less? Do you prefer less, more, or are you indifferent? So we'll give you a couple more seconds to get your votes in. And also, as a reminder, we are recording our presentation this afternoon, so we will post both a copy of the slide deck as well as the recording. So we'll give you a couple more seconds to submit your responses. And we'll close the polls in 3, 2, 1. And we'll take a look and see how our audience responded.
So what do we have, Stacy? Can we tell?
Yeah, so it looks like a lot of you are almost equal, saying 42% prefer less disaggregation and about 39% more. So that's interesting. Seems like the audience is a little bit undecided as a whole. But not to worry, there'll be time to figure it out.
And again, one of the things that we do want to point out is that there are options here, and it's going to be different for different organizations. I think the key thing is to sort of right-size that presentation so that it's got enough detail to be useful, but doesn't overly clutter up your statement of financial position. The last example of a financial statement we wanted to show you was the statement of activities, and with only two different classifications of net assets, you've got only two columns of classifications of net assets. So in the statement of activities, the column with donor restrictions would include the permanently restricted as well as the temporarily restricted activity. So that could simplify. I know a lot of my clients certainly are using that multiple column presentation, and this would allow you to reduce it by one column. I don't know, I'm expecting that this will probably be what most organizations start with anyway. It's the most similar to what I think is the most prevalent presentation, at least for my clients. So it will be easier to transition. It will look familiar to people. There are some other options where, you can do a lot of different things, including rather than having this in a multi-column format, having the donor restricted beneath. We felt that that looked kind of cluttered. It got to be a long, skinny financial statement, and then it was a little bit harder to follow.
Doesn't really facilitate a multi-year comparison too easily either.
That's right.
Yeah.
So it's acceptable. So if that's something that you think is useful to you, you could certainly do it. The other one that we don't have here, but we'd certainly
I would just say too that a real benefit of the multi-column format is that we get to see the current year change in net assets in both categories, the beginning and the end. And to me, that's like a nice little, like a roll forward schedule that's nice to see for both categories. So.
Right. So the other option that some organizations may want to consider is a two-statement presentation, and this is new. We don't have it in here. It is in the standard itself, but that would show basically the without donor restrictions as one statement, and then with a follow-up of changes in net assets. So for, I don't know, I guess I'm thinking that while this one is probably more similar to what people are currently looking at and therefore more acceptable to external readers. The two-statement format could be interesting for an organization that really wants to emphasize their current year activities with a little bit more of a focus on something resembling operations. So that's something that you can consider and discuss. We're happy to discuss it with individual clients to see whether or not it's a useful alternative for you.
And I think also that a trend that we're going to be seeing on a statement of activities is you see the investment earnings, the net realized and unrealized gains, and the interest and dividend income up there as, you know, just part of the revenue section. I think we're going to be seeing more nonprofits, certainly charities, that are going to be pulling that out and going to be having a subtotal changes in net assets before investment earnings, then their investment results from investments, and then finally to the ending change in net assets. So I think that's going to be a trend we're going to be seeing.
Thanks, Mike. Okay, so we have a few slides on disclosures for net assets without donor restrictions, and under current GAAP, there's not really any specific requirements for disclosures about unrestricted net assets or board designated net assets. You're allowed to do it, doesn't expressly prohibit it, but doesn't require this. Under the new standard, if there are board designated net assets, they do need to be disclosed either in the face of the financials or in the footnotes, and you need to separate out anything that's considered to be a board designated endowment versus other types of net assets. The idea is that the readers of your financial statements, your board members, your creditors, your donors will have a lot more relevant information.
I was just going to say, Renee, on the kind of just a segue into the internal designations. This is going to be important also in the liquidity section when we get to that point in the presentation today, because you do need to, as Renee mentioned, separate those. So for example, reserves for capital improvements, you know, scholarship funds if you're a college or university, things of the like that are very different from a board designated endowment, but can be available if needed to fund operations. So we'll go over that difference a little bit more in the liquidity section.
Yeah, and I think another thing, you know, one of the things that we look at when we're benchmarking our clients, and that I think a lot of external sources look at, is how much is available to an organization as working capital. And to me, looking at this new standard is an opportunity to look at whether or not establishing a formal reserve policy for your organization is something that you should do. I think a lot of organizations have sort of informal reserves, but I would say a minority of my clients have formal working capital reserves. So
I think it gives a board the flexibility of not having to go all the way to a quasi-endowment in order to have a set-aside, but instead be allowed to just do a set-aside and call it a reserve and have a reasonable, you know, like a rationale behind that. It's a disclosure requirement, what that rationale is. So the note at the bottom on this slide, I find it interesting because historically I have felt obliged to ensure that boards have actually made the board designation, especially if it changes from one year to the next. And so this here gives boards, they have the flexibility, they can simply delegate that authority to management. So it still gets captured as a board designated net asset, even though the board may not have acted, you know, specifically on this year's change or this year's activity within that designation. So.
okay. All right, so just have a couple of recommended actions, and I think we've really discussed these already, just trying to keep, you know, if you have a lot of disclosure, keeping it in the footnotes and making the statement of financial position clean and easy to follow. And this is an example of what could be in a footnote for some board designated or net assets that have been carved up without donor restrictions. And this is an example. Again, we've already kind of seen this. This has got it on the statement of financial position in multiple categories. Same timeline leading up to it. I think organizations are going to need to, figure out, do we have board resolutions where we have already set up designated funds? Should we have a reserve, and if so, what?
And many organizations out there, many social service, and even in the school and the college and university space, many of you are already disclosing certain designations, either, whether they're internal or some sort of board designated endowment. So again, it's not precluded in the current standards. So this is something that you can certainly start, carving out and disclosing early.
Great, thanks, Stacy. Okay, so we've already mentioned that there's going to be some additional disclosures required, so let's go through those very quickly. If you do have an endowment, all of the existing disclosures are still required. So, that's going to include the spending policy, whether or not you're subject to a MIFA, etc. The footnote's going to get a little bit longer. It's already a pretty long one. But you will need to add these additional disclosures. The board's interpretation of the ability to spend from underwater funds. The MIFA change a few years back allowed that, and this is going to require that the financial statements disclose how the board has determined that it can spend or can't. We already mentioned that underwater endowment funds are going to be back in the donor restricted section instead of in the unrestricted area. And you'll need to update that spending policy to talk about appropriations from underwater endowments. And then finally, the investment return, you don't have to have the interest, dividends, etc. on a separate line from the change in fair value. You can put all of the investment return into one line if you like. I think a lot of board members or finance committee members may prefer to see those broken out, but the option is there to simplify it. And again, keep in mind that, on some level, the audit is for external users, so there may be things that you don't necessarily want people outside the organization to see as much detail. You can always report whatever you want internally.
Having said that, though, don't lose sight. When the 990 is prepared, it's going to have your interest and dividends and realized gains and unrealized gains all reported separately and individually, so you still have to keep track of that information.
Mike, do you think we're going to see some revisions to the 990 coming out in the future that might mirror some of these changes? I know that's been a question that's come up a lot.
Yeah, I don't anticipate that much of this is going to make its way. When the 990 did the big revision back in 2008, their concern was trying to get better information out to the public. This is also an attempt to get better information out to the user base. I don't know that it's going to translate into 990 changes, these financial statement changes.
So we got a question, and I'm sorry, I didn't realize that this was a term, I should have, that not everybody's familiar with, and that is, what's an underwater endowment? So an underwater endowment is an endowment where, let's say a donor has given you $10 million, and the next week the stock market tanks and it's now down to $9.2 million. That would be an underwater endowment, where if it's an endowment that has been set up, you're not supposed to spend the corpus, it throws off earnings, maybe in perpetuity, whatever the terms are, but that has gone below the value of the initial contribution. So in that case, the example I just gave, that would be $800,000 underwater. Under old GAAP, that $800,000 would have hit your unrestricted net assets. This puts it back in the net assets with donor restrictions.
And that was the general rule. There was some funky depending on how it was invested, but the bottom line is that this is now all going to be part of the with donor restrictions.
Okay, there's a little bit more disclosure required on the underwater endowments, but it's not all that significant. It should be fairly easy for most organizations to comply with. So just a few things that you need to do here to prepare. One thing might be, do you need to break up within your investment portfolio donor endowments and board designated endowments? Probably not necessary to set up two separate accounts, but you may need to improve the tracking so that you can report it easily within the financial statements. We do recommend that even though you can combine all the investment changes that on the financial statements, that you continue to show it in different accounts within your general ledger. It's a lot easier to tie back to things like your investment statements when you've got an account for each one of them. And again, we've kind of already covered these different options for disclosure versus putting things on the statement of financial position. This, again, is an example of an endowment disclosure. This would probably be in the footnotes here where the board designated is broken out from the donor restricted, two types of donor restricted here, and then you'll see that the two columns show the activities within the year. And this is just another version of this that, again, is going to appear in your footnotes.
This is the roll forward.
This is the roll forward. Mm-hmm. Okay. So again, I think we've covered most of this, and we can probably just head into our next section, which I think Mike is going to start us out with functional expenses.
The SFE, the Statement of Functional Expenses. I think this is one of my favorite pieces of the new nonprofit reporting model, is that I no longer have to explain to people what is a voluntary health and welfare organization. That definition has always mystified. Here's what every exempt organization is now going to be required to present: some sort of functional expense by nature and by function. The examples that we've been given are actually tightening up, it seems. We don't have, as in the examples and in the definitions, there's not nearly as many natural expense categories as what we're used to seeing. You're going to see an example in a couple pages that has literally 7 categories. There's a couple more that are mentioned in the glossary and in the actual ASU. So there's multiple ways to do it. There's an option where you can actually do this on the face of the statement of activities, although I will frankly tell you that none of us have seen an example of how we plan to make a 3-dimensional statement of activities. Typically, I think what we're going to see is the old classic statement of functional expenses, or alternatively to take that identical information and put it into a note to the financial statements. An item of note: we do a lot of trade organizations. C6 organizations are not required under current GAAP to have to present this information, present the matrix format of it. They will now have to do that, and member services is, of course, one of the functional categories. Beside, there's program and there's management and there's fundraising, but there would also be member services in a membership type organization.
That's an interesting point, Mike, because on the 990 for public charities, you're required to do the functional presentation. So, you know, that same presentation to a certain extent is going on between the 990 and the financial statements, but membership organizations don't have that functional reporting requirement on the 990. Is that right?
That's correct. So they'll have to do it now for GAAP purposes, but it won't affect their 990 reporting. So.
Yeah.
However, for the 990 reporting, they're still going to have the same number of expense categories in part, I think it's 10 of the Form 990. Well, it's page 10, so it must be part 9 of the. So you're still going to need to keep track of all of the same expense categories, at least a minimum, in order to fulfill your 990 reporting responsibilities. So again, don't make a lot of changes. You know, don't start minimizing. I guess it makes sense to make some changes to your chart of accounts, but be cognizant of the fact that you're going to need some detail for the Form 990 that you may no longer need for your GAAP reportings. Topside reallocation approach when it comes to when you're doing your reallocations of indirect and or shared expenses, depreciation, interest, shared salary, facilities, occupancy, etc. those still need to be reallocated among the categories, the explicit categories of program management and fundraising. So, and then investment expenses no longer, we used to have an option with investment expenses where we could either report them as a functional expense or alternatively as a contra revenue in the statement of activities. That is no longer an option. Now we have to do it as a contra revenue on the statement of activities. It's an offset to the investment income. And it also, I think it expands the definition of it's not just your actual out-of-pocket investment expenses, but it's also to the extent that you have people within the organization that are actively managing that your investments, their expenses would also be part of that contra revenue, that offset. So.
And you're not probably going to do that if a very small portion, right? This would be more, I don't know, Stacey, maybe with one of your college and university clients that maybe they've got someone helping to manage their endowment or.
Yeah, typically we're going to see this being more of a bigger, I'm using the word material or more significant change in the financial statements for those nonprofits or colleges, schools that do have larger endowments where those funds are invested.
Yeah. I would think a community foundation, that could be a very significant dollar amount too. So, but I think, a lot of the social service organizations, it's not something that's going to be material.
I think that for charities, they should be so lucky that they have so much investments that they actually have to internally manage. But I also think that realistically, they'll just get a board member that has the expertise, and then they'll have to make a decision as to whether it's a donated service expense that needs to be reported. So on the next slide, we're going to see a matrix. Oh, here we are. Okay, so on the slide, so here you can see there's only there's only 6 natural expense categories in the GAAP example. So this is far less than I know that we're used to seeing. You can see there's some condensation. So I'm anticipating that we're going to see a trend toward fewer line items in functional expense presentation. I'm going to turn this over to, I think we're ready for polling question number 2.
Okay, so we have our second polling question. So in just a second, you will see it on your screen. And just a reminder, we do ask that you respond to a minimum of 75% of all the polling questions if you're looking for that certificate of completion. So which is your preferred method of functional and natural expense classification? A separate statement of functional and natural expenses, a footnote disclosure only with no separate statement, or are you not sure? So take a minute to think about that and submit your responses. I see a few coming in. And as those are coming in, we did have a question in terms of where the slide deck and the recording will be posted. Everyone will be receiving a direct link, but it will be on our website, which is armaninollp.com under events. Okay, so we will close the poll in about 3 seconds. So 3, 2, 1. Thank you for submitting your results. Let's take a look and see how our audience responded.
So it looks like most of you, about 61%, prefer the separate statement functional expenses. 27% prefer the footnote disclosure without a separate statement, and 11% of you were not sure.
We didn't even give you the option of doing it on the statement, the face of the statement of activities.
No.
Just a couple more details about the functional expense presentation. Again, as I indicated, there's probably some work that needs to be done on your chart of accounts. So if we could get a slide move here. At the top there, so we probably start taking a look at that. We're looking at the same implementation period. One detail is that if you're doing comparative financial statements, in the year of implementation, in the first year, in the predecessor year, you do not have to show the same presentation of both functional and natural classifications because it wasn't done in the prior years.
Unless you're a voluntary health and welfare organization.
You can't be serious. They did, well, of course they had that years. Renee just pulled a trick on me. Statement of cash flows. That was awesome. Direct versus indirect. Here's the deal. Back at FASB 95, early in my accounting career, well, maybe not so early, but back in the earlier stages of my accounting career, we were given the option of doing either the direct or the indirect method of the cash flow presentation. However, we were told if we used the direct method, we nevertheless still had to do the indirect method. I see almost no direct methods on a statement of cash flows. I see some, but I don't see a lot. I see them in affordable housing because it's HUD requires it, but other than that, that requirement is now gone. We can do one or we can do the other. We're not required to do both if we do one. So that's kind of a handy move. I'm anticipating we're probably going to continue seeing the indirect method. One of the things that I noticed is that in the direct method, I mean, in a for-profit business, it probably, you got sales and you got accounts receivable. But in a nonprofit, you're going to have contribution revenue, you're going to have program service revenue, you're going to have collections of prior year pledge receivable revenue. So there's going to be a bit more work, and actually there's going to be probably a lot more work. So we're anticipating we're not going to be seeing a lot of direct methods, even though that option has now become simpler.
And I think a lot of mid-size and smaller organizations look to their outside accounting firms to prepare the statement of cash flows. I'm going to be honest, I think that the direct method is very difficult for someone coming in from outside to do. You've got to really dig into some underlying data. So if you do want to present the direct method, it's probably something that will need to be done by management.
And implementation, same as everything else, calendar 18 or fiscal year ending in 19.
Okay, moving on to polling question number 3. Give us just a second to launch the question.
While we're waiting, I have a technical question for Renee. If I formed a charity on December 19th of 2017 and then its fiscal year end was going to be a calendar year, so I had a stub period of 11 days, would I be doing a calendar 2017 then implementation?
I think you're going to do a from inception to date. Oh, but yeah.
If I have a calendar year and raise $2 million, so in California I got the nonprofit integrity. We're trying to get there. We're trying to get there.
So the question is, which method of cash flow would your organization present? Direct, indirect, or are you not sure? So we see that some people have submitted their responses, so thank you. I'll give you a couple more seconds to think through before we close the poll.
We don't even have to wait for the polls to close here. We're calling it.
All right, let's go ahead and close the poll.
ABC has called this a race.
So 67% of you prefer the direct method. We like
Indirect.
that.
Indirect
method. I'm sorry, we like that. 18% are preferring the direct, and 15% of you are still not sure.
All right, thank you.
Okay, so moving back to our presentation, I think some of the different presentation options, we've already referred to a number of these. The current situation, you've got 3 required statements, 4 if you're a voluntary health and welfare organization. Under ASU 2016-14, everybody's still going to do a statement of financial position. Everyone will either do a statement of activities, or, as I mentioned, there's this alternative to do 2 different statements, one which in the example is called a statement of revenues, expenses, and other changes in net assets. So that you could have as many as 5 different statements in this scenario. Every nonprofit is going to do the functional presentation, as Mike mentioned, but it can be in a footnote. And finally, still doing a statement of cash flows. There's one other accounting change that we wanted to quickly, we wanted to point this out. While today's presentation is on ASU 2016-14, there's two other fairly large pronouncements that you've probably heard something about. One is revenue from contracts with customers. That's not going to apply to contributions, but many nonprofit organizations do actually have customers and sales, so you may need to be considering this. The other thing is the new lease standard, which is pretty much going to require that leases end up on the statement of financial position and get capitalized. So we don't have time to go through these today. Basically, we wanted to remind you that the effective dates are kind of in the same ballpark as the ASU 2016-14. So if you're going to make big changes to your financial statements, you might want to consider addressing this at the same time. And then, Mike, I think you were going to talk quickly about a couple of other accounting changes under the standard.
Well, just to the extent that somebody has donated you a long-term asset, and under current GAAP, we have the option of either doing just a placed in service approach when the building has been either built, completed, or placed in service, that we just move the entire amount out of with donor restrictions into without donor restrictions. We used to have the option of also doing that over the life of the asset, so essentially using a depreciation methodology so that we would do an annual amount that would take maybe 30 or 35 years. That option is no longer available. We will now be moving it as soon as it's placed in service, unless the donor has given us other explicit stipulations. Other, if there's like a donor restriction that says that we want it to be done over time. So.
Very few organizations use this option. I think I have one client that does it.
Yeah. As do I. No.
Okay.
Same implementation guidelines. So I think we're going to move into liquidity, and we're going to turn this over to Stacy.
All right, thanks, Mike. All right, so before I get into the liquidity section, I guess I just wanted to mention that, I know there's a lot of concern out there regarding the implementation of these disclosures in your financial statements. I know that many of you are worried about how, in the story that your financial statements are going to portray to the external donors, creditors, other constituents and users of your financials. And definitely that is a reason for concern, but I know that, when Renee and Mike and I look to partner with our nonprofit clients, it's more about following the compliance with the standard, but putting your nonprofit financial statements in the best possible light and telling the best story that it can about your organization while being in compliance. So you should definitely have these conversations with your external auditors earlier. Hopefully that'll help to alleviate some of the concern that you have. And I think it's important for us to continually remember that the Financial Accounting Standard Board and their purpose for requiring these disclosures was to provide transparency and utility of information across various subsectors within the nonprofit industry. So that's important too. So for any users of financials that are looking across many nonprofit organizations, they're going to see similarities even though each organization has a different story to tell. Okay, so in terms of the new GAAP requirements and the new GAAP guidance, there's no old GAAP guidance to refer to. I always, it's interesting. I've in my experience that sometimes the only time that we come across any type of liquidity or going concern disclosures in the financials is obviously when it becomes an issue, right? There's nothing. In the financials that eludes anybody or alerts any third-party user that there might be an issue going on. And so I, for one, like these new disclosure requirements because I think that it will provide transparency, again, not in a negative way, but at least it starts to provide a history and will tell the story over time. So as far as there's qualitative information and quantitative information that's needed in the financial statements to comply with the new requirements. The quantitative information can be on the face of the financials or in the notes, basically communicating the availability of the organization's financial assets as of the statement of financial position date or the balance sheet date to meet cash needs for general operating expenditures. And that's within 1 year from the statement of financial position date. Can you go back one slide? Sorry. Still on qualitative information here. So the information should also include how the nonprofit manages those liquid resources in order to meet those obligations. That includes disclosing 4 key items. One is unusual circumstances such as special borrowing arrangements. So for example, those types of arrangements could tie up liquidity. So if your organization has debt, the terms of those debt agreements, such as having to hold compensating balances or any kind of debt service reserve or the like, that could impact liquidity. So that's something important that needs to be disclosed.
I sometimes see that even just to secure credit cards.
Exactly. Mm-hmm. And known liquidity problems is another required disclosure. So a couple of good examples here are when you know, for example, that you're losing a significant stream of funding that won't be replaced. So in our world, especially in the social service world, where a lot of them are relying heavily on government funding, federal funding and other government funding, that can be a known liquidity problem if the organization loses that funding. Also, some of our organizations, if you have a for-profit element to your business, where the demand, if you will, for the for-profit good or service is no longer there, diminishing. Okay, so again, that could impact and cause liquidity problems that you may know about or be able to predict. Also, if you're having a hard time maintaining cash balances to comply with donor-imposed restrictions, those need to be disclosed as well. So again, if you're experiencing declines in some aspect of your business, such as a loss of funding or something of the like that we see, and you have a deficit, for example, in your unrestricted net assets, that's definitely an indication to an external user that you might be using some of those restricted funds to cover your what we'll call general operating expenses. And so that's something to consider within this disclosure.
That's a great point.
And then any other limitations from any other contractual agreements, pledged collateral, for example. A lot of times nonprofits have pledges receivable or accounts receivable that are collateral for debt agreements, and so a lot of times those are limited because in the event of any kind of default, those would be called upon.
Mm-hmm.
As far as the quantitative information on the face of the financial statements or in the notes that I mentioned, communicating the availability of the financial assets to meet those cash needs, the nature of the assets needs to be disclosed. So for example, the disclosure needs to list out like cash, receivables, and other assets that are otherwise not available to meet those liquidity needs. Internal and external limits imposed either externally by donors, laws, contracts, etc., and then the internal limits imposed by your governing board decisions. So a lot of those internal limits, just to get back to the conversation that Renee had earlier in the net asset section, those are not only limited to quasi-endowments or board-designated endowments, but they're also limited to those scholarship funds, those reserved for capital improvements. And in the case of this new GAAP, this new standard, some organizations may find themselves in a position where they need to start building a specific liquidity reserve. So that might be an additional limitation internally that's established and disclosed. But again, I think it's important to distinguish between external and internal because your financial statements are going to tell the story differently on the internal limitations, right? So a lot of those internal limitations, those assets can still be freed up in most cases to fund those operating expenditures. So it's very important that those distinctions are made in these disclosures. Do you guys have any other examples of any other internal limitations that we didn't already discuss?
Well, I think we talked about a variety of those, like board designations, board set-asides.
Okay, all right. So again, the slide that's up here, just a full recap of all of those required disclosures and presentation matters that we went over. Description of the assets, information on the limitation and the use of cash and cash equivalents, contractual or other limitations, and then those internal limitations and those imposed by the donors. All of that is required under the new GAAP guidance. Just a few action items here. again, you should take into consideration any, just like you're doing with your net asset chart of account structure as a whole in terms of the with and without donor restrictions. So kind of that same concept in this first bullet point. You should consider any changes that you need to make to track financial assets separately in your chart of accounts that may link to different liquidity disclosures. Again, we don't want you to take your chart of accounts and splice it up and add a ton of different and new accounts to it, but we want you just to think through the disclosures and the information that's going to be needed in your financial statements and just make any internal changes that will help the presentation easier and tell your story in that best possible light.
Yeah, it's always easier to add up a couple of accounts than it is to tear apart the detail inside one.
That's a true statement. Again, we just recommend that you keep the face of the financials as simple as possible, but again, this is something that should be discussed with your board and other constituents regarding what's the best possible situation to disclose your information. If you have comparative financials in the year of adoption, you have the option to present the liquidity disclosures only in that year of adoption. So again, if you have comparisons, you don't have to present the comparative year that's in your financial statement package. Just wanted to point that out. Okay, so let's look at a couple of examples here. The first example is a liquidity disclosure using a classified balance sheet approach. So a couple of different things. You'll see at the top of the page here is sort of all the qualitative information about the general limitations and restrictions, both arising from donor and internal limitations and restrictions, but also certificates of deposit, for example, there in the middle that are being required as collateral for the notes payable. Short-term unconditional promises to give that are being used for a capital campaign that aren't going to be available in that near term for operations. All of those things are important to disclose in the qualitative piece. And then you can see down there at the bottom in terms of the quantitative information. The quantitative information breaks out the balances of the financial assets off the face of the financial statements that are available for current use within 1 year.
So this is a lot more information than what I think most organizations are currently disclosing. I think it's going to be a fair amount of work for management to prepare for this.
Yeah, this is a lot more information than some of my clients have.
Yeah, and this is a good example where, we mentioned before, having a classified balance sheet might facilitate, more utility in terms of ease of use of this footnote and, being able to tie it back or link it back to the face of the financials. In the next example that we'll show, again, this is an example where you have the qualitative information in the narrative, that sort of talks through the limitations and restrictions. But you start in the quantitative piece of it, you start from a different standpoint in mind. So it's almost capturing the total of the financial assets on the statement of financial position, and then looking at that in total and saying, okay, we have all of these net assets that are have these various restrictions imposed, either contractual or donor-imposed restrictions or our internal board-designated endowment. And then it's getting down to a net number of those financial assets that are available to meet those general expenditures within 1 year. So again, it's a different way of looking at it. It's a different way of presenting the information that still meets the criteria in the standard, but also dependent upon how you're presenting your financial statements. Classified, non-classified, or even if you have more information in terms of the breakout of the restrictions on the face of your statement of financial position, like Renee mentioned earlier in the presentation. Again, there's lots of decisions to make here in terms of these presentation and what makes the most sense for your organization, especially depending upon what subniche you're in. So start these conversations early with management, boards, external users, and also your auditors.
Yeah, I think this is a really striking example of an organization that looks like it's got lots of money, but 2/3 of it is actually needed for things besides current operations.
Yeah, exactly.
Okay, so we are at our last polling question. I know we're running out of time here, so we want to give you your opportunity to gain CE. So the last question is, do you think the liquidity disclosure requirements will call for more scrutiny from external constituents? and then select either yes, no, or are you indifferent. So we'll leave this open and give you a little bit of time to respond.
I think this is one of those landslide questions too.
So again, this will be our final polling question, and we are just about at 4. So, all right, we'll go ahead and close the polls in 3, 2, 1.
Yeah,
and let's take a look at the results.
Looks like a landslide. Most of you are saying yes, this is certainly going to cause more scrutiny, and it will. It definitely will. We're not discounting or saying anything otherwise, but again, it's more about telling your story and just making sure that it's portrayed in the best possible way.
I'm anticipating there's going to be more scrutiny from audit committees and boards of directors as well when we first start bringing these in the first time around.
And the implementation timeline, it's the same time frame as what Renee and Mike have mentioned in terms of the other components of the new requirement. Only caveat there that I mentioned is that you have the option to only present these disclosures in the year of adoption for a comparative set of statements.
And this is what we've covered in our webinar. We've discussed the changes between the 1993 Statement of Financial Accounting Standards and the new ASU. We've examined how the changes will affect donors, grantors, creditors, and other users. And we've also identified implementation deadlines and the benefits and pitfalls of early adoption. So I'd like to thank our 3 presenters. We did have some questions that came in, so we were able to capture those. And so if you did submit a question, someone will be responding back to you. But I'd like to thank our 3 presenters today and thank everyone for their participation as well. On the screen in front of you, you do have all 3 of our presenters' contact information in terms of their phone number and email. So if you did not get your question answered and would like to reach out to them directly, you are more than welcome to do so. But with that, thank you everyone for your time and enjoy the rest of your day.